And we move to the third paper. We have Hyeyoon Jung from the New York Fed, shedding light on the credit card market in the US. And the discussant is Larissa Schäfer. Hyeyoon, you have 25 minutes. Please. How do I get back to the first page? No?
Okay, great. Thank you so much for having this paper in the program. My name is Hyeyoon Jung, and I'm very excited to present my paper, Credit Card Banking. This is joint work with Itamar, Weiyu, and Guanyu at Wharton, and Dominik from Colombia. And I'm at the Federal Reserve Bank of New York, so the usual disclaimer applies. The credit cards are central to consumers. In the United States, 3 out of 4 adults are having a credit card, and 70% of retail spending is made with credit card. And what's surprising is that a large share of credit card users are borrowers rather than transactors. So 60% of credit card accounts, or 85% of balances, are borrowers. So what this means is that credit cards are not just a payment tool, but it's also the main source of borrowing for consumers. And then what this means is that credit card rate determines their marginal cost of consumptions. And we show that this rate is very high. Credit card rates are very high. The average annual percentage rate, APR, on credit cards in 2023 was 23%. And this is 18% above the Fed funds rate. And these spreads are much higher than the spreads on all other loans or bonds. For instance, C&I lending is only about 2%. Mortgages are 3%. And even high-yield bonds have 4%. And you can see that credit cards are having 18% of spreads. And you might think that these are driven by the households having low FICO scores. However, we actually show that credit card rates are very high for all FICO scores. What you see here is the effective interest spread on the y-axis across different FICO scores at origination. And you can see that even the highest FICO of 850 pays about 7% of interest rate. And across all these FICO scores, we find that the average spread is about 14.5% in our sample. And we are going to decompose this 14.5% into different components to understand what's driving this high interest rate. So because of these high interest rates, credit card lending generates high profitability. Banks make 16-17% of banks' interest income from credit cards, and it constitutes only a small part of bank balance sheets. And of course, at the same time, credit card lending is the riskiest form of the lending that banks do because credit cards are unsecured consumer lending. And on average, more than half of banks' annual default losses come from credit card lending. So credit card lending is risky and profitable at the same time. So here are our research questions. First, we ask this question: why are credit card interest rates so high? To answer this question, we analyze credit card lending as an asset class, and to understand the pricing of the credit card rates. And we compare these pricing to other types of lending, for instance, corporate bonds. And second, what are the economics of credit card banking? To answer this part, we investigate all streams of revenues and costs. And we think about whether there's a market power in credit card banking and how does it relate to the pricing of credit card rates, which is going back to the first question. So why are credit card interest rates so high? We have 4 potential explanations. The first is about the expected credit losses. If the expected credit losses are high, to compensate for that, the interest rate could be high. So that's our first hypothesis. And the second is about reward costs. These days, credit card companies offer various benefits like cashbacks and mileage, and that could be costly from the bank's perspective. And to recoup those large reward expenses, banks might be charging high interest rates. So that's our second hypothesis. And we know from the literature that banks can have pricing power because of imperfect competition or search and switching costs. So our third hypothesis is related to the market power. And our final hypothesis is about the risk premium. If default risk is not diversifiable, and if the risk tends to go up during the bad times, then the risk should be compensated. So that's why the credit card default losses can carry a high risk price. So I'm going to go over each of these potential explanations. And how do we test the hypothesis? We use Federal Reserve regulatory data, Y14 data, which is used for bank stress test. And we have data we focus on the data on domestic credit card operations of large US banks. And this is a very comprehensive data set. We have 20 banks in there, which accounts for more than 90% of all US credit card lending. And it's very granular. It's at the account level, and the data includes the rate, interest rate, APR, balance, fees, interest, purchase volume, rewards, promotional status, and then borrower characteristics like FICO score and borrower income, and we also have credit limit. And we complement this account level data with the portfolio level data, which covers these variables. And we end up with 330 million observations per month over the sample period from 2015 to 2023. So here's our approach. So how do we make use of the data? We track lifetime performance of accounts originated between 2015 and 2017. And then we examine all the revenues and cost components, including interest, charge-offs, interchange, fees, rewards, and operating expenses. And in each month, we make distinction between borrowers and transactors. This is important because they're very different. Borrowers carry balance and they have to pay interest unless they are under promotion. And on the other hand, transactors pay balance within the deadline, so they don't pay interest. And then our third step is we further sort these borrower and transactor accounts by their FICO bins at the origination. And why do we do this? A, because sorting on FICO at origination creates a large spread in default risk, so we want to exploit this cross-section. And B, APR spreads are typically set at the origination and based on the FICO score, and they don't change over the account's lifetime. So we use these FICO bin portfolios cash flows to analyze the risk and return of credit card lending. So let's start from the first hypothesis, going back to our research question, why are credit card rates so high? Our first hypothesis is because the expected credit losses are high. So we ask a very simple question, do credit card spreads equal the average charge-offs? And what you see on this green area, this is the net credit loss, and you can see that this chunk is big. So on average, the credit card charge-offs, net of recoveries are high. We find that it's about 5.8% per year. And looking at the FICO cross-section, moving from the low risk to high risk, of course, it's not surprising to find that the net credit losses are bigger for the lower FICO score. And now let's look at the interest income, which is the blue part here. And you can see that this covers the entire net credit losses, and it also increases in the default risk. And because the blue part is increasing even more than the green part, the net credit spread, which we call default adjusted credit spread, which is the black line on the right axis, this one is strictly positive across all FICO scores. So what this means is that even after subtracting, while the credit card charge-offs are high, even after taking this component out, there is a substantial part of the credit card spread that is not explained by the expected charge-off rates. So that was testing our first hypothesis. And then what else can be there? We thought about the rewards cost because banks offer various rewards like cashbacks and mileage. That could be costly for banks, and the high credit card rates may help recoup those high rewards expenses. So that's our second hypothesis. And what do we find? We find that banks do spend a lot on rewards. They spend about 1.6% of purchase volume. But we find that this is actually fully covered by the interchange income, which is the swipe fees that the banks collect for each swiping of the credit card. And that's about 1.8% of the purchase volume. So taking the both sides into consideration, the interchange rate net of rewards, which is green line here, we should read it from the right axis, is positive across all FICO score for both transactors and borrowers. What you see on the left-hand side, this is the transactor count, and the yellow part is the interchange income. The purple part is the reward expenses. The green is the net, and you can see that it is strictly positive across all FICO scores, and the same message from the borrowers as well. So what this means is that rewards do not really explain the high credit card spreads. So that was testing our second hypothesis. And then we thought about market power and operating expenses. So while examining all the income and expense components of credit card business, we find that the credit card banking involves high operating expenses. They spend about 4.85% of balances, and this is much higher than the average commercial banks, which typically use about just 1% of balance in the operating expenses. And among those operating expenses, we find that the banks spend a lot, especially on marketing. So for instance, Capital One spent $4 billion, and American Express spent $5.5 billion in 2023 in marketing. And these are comparable to Coca-Cola and Nike, which are the largest marketers in the world. So why are they doing this? What we have in mind is that high spending on operations or marketing helps drive customer acquisition, and that they help build market power. And we have a suggestive evidence supporting this idea. We find that banks with higher operating expenses charge higher interest spreads. So what you see here is the borrower interest spread on the y-axis, operating expenses on the x-axis, and these are bin scatter plot from the bank and FICO bin level. So one dot represents can represent different banks for different FICO bins, but you can see that the relationship is positive and significant, and this is already after controlling for the FICO fixed effects. So what this, I can show you the regression results as well. So if we regress the interest spread on the operating expenses, we find that the coefficient is positive and significant, and the same idea for the gross margin. So what this means is that banks' operating expenses are strongly related to the interest spreads and the gross margins, even after controlling for the FICO score. So it makes sense to think that operating expenses are incurred to obtain the pricing power. And on the third column, in contrast, when we regress the net charge-off on the operating expenses, we find no relationship. So this suggests that higher operating expenses are really for marketing to obtain the market power, not for improving the screening of borrower creditworthiness. So that was related to market power, and now we put these pieces together, and here are the different components of the credit card banking business. The blue, red, and green parts, these ones are the parts that you've already seen when we talked about the first hypothesis. And then we add on the yellow and blue parts that you saw from the second hypothesis. And after netting these out, we get this net ROA, return on assets. That's the black line on the right-hand side, right axis. And on average, we find that the ROA is very high. It's about 6.8% for the aggregate portfolio of borrowers. And as a result, at the bank level, credit card banks can earn about 3 times the ROA of the average bank. And what's interesting is that the ROA increases in default risk. So ROA increases from about 5% for the 800 FICO guys, and 8% for 660, and then almost 11% for 625. So this ROA increasing in default risk suggests that there could be default risk premium. So that's going to be our last hypothesis. So if the default risk is not diversifiable, and if the default risk tends to go up during the bad times, the risk should be compensated. So what you see here is the charge-off rate of different asset classes, like credit card, consumer loans, C&I loans, and mortgages and corporate bonds. And you can see that the credit losses tend to move together strongly. And the shaded areas are the recessions, and you can see that the credit losses tend to move together, and they tend to go up during the bad times. And the black line, this one is the credit card charge-off rate, and you can see that it is the highest and the most sensitive charge-off rates compared to other loans and bonds. So this again suggests that the high ROA of credit card lending may be coming from the default risk premium. So one message here is that the banks cannot diversify this risk by investing in different types of assets. And even within the asset class, even within the credit card asset, across different FICO score, that's what you're seeing in different colors, the charge-off rates move strongly together. So this gave us an idea that these charge-off rates load on a common default risk factor in credit card market, and different FICO bins can have different sensitivity or beta to the common risk factor. And the lower FICO portfolios charge-off rate is higher and more volatile, so we're going to find higher beta to the common risk factor. So taking this idea, we estimate a one-factor model of deferred risk and risk premia. How do we do it? We estimate a time series regression as the first step for each FICO bin. So for each FICO bin I, we regress the change in charge-off rate on the aggregate change in aggregate charge-off rate as a proxy for the systemic default risk. And we're going to obtain the beta for each FICO bin. And what you see here on the blue line is charge-off rate on the left axis and the beta on the right axis. And you can see that the charge-off beta goes up as the FICO bin goes down, as the default risk goes up. And this is pretty much linear. So this is consistent with the idea that the FICO portfolios has a strong one-factor structure. So we take these beta estimates, and then in the second step, we estimate the default risk premium. So here, this is a cross-sectional regression. We regress ROA of different FICO bin I on the beta coming from the previous step, And the gamma is going to be the price of default risk, and gamma times beta is going to be the risk premium. And what you see in the blue line, this is the credit card ROA, and the black line is the fitted ROA coming from here. And you can see that the two lines are close to each other. This means that the model fits very well. And in terms of the estimates, the gamma is the price of default risk. And we find that the aggregate default risk premium is about 5.3%. And lambda, the intercept is 0 beta rate, and we find that it's about 2.4%. And interestingly, we find that this is close to the transactor portfolio, which is very low default risk, which is about 2.6%. So we find that this adds validity to our estimates. And what if we compare this, this risk premium to the overall banking sector? We find that the overall banking sector's default adjusted ROA is about 1%. So comparing these 1% to the 0 beta rate, we find that the credit card lending earns about 1 to 1.4% relative to the overall banking sector. And we also compared these numbers to other types of assets. In particular, we thought about corporate bonds. And what you see here, these are the same black and blue line. And the purple line is the gamma times beta, the risk premium of the credit card banks. And the green line, this is the risk premium of corporate bonds by mapping the bond ratings to the comparable FICO scores. And you can see that they are pretty much in line, especially for these B to BBB rated bonds. But for the lowest bonds, we find that there is about 3% gap. So putting all these components together, here's the decomposition of the credit card spread. The alpha, this is what I just explained. The credit card banks are earning about 1 to 1.4% higher return compared to the overall banking sector. So alpha is contributing to the high interest rate. And these three components, the operating expenses, risk premium, and charge-off, these are also important components explaining the high interest rates. And if you add up all these numbers, we go back to the 14.5% that I showed you in my first slide. So to conclude, the credit card interest spreads are far higher than those on other types of loans or bonds. And there's a large cross-sectional difference in FICO portfolio, ROAs, which can be explained by a large default risk premium. And as you can see from here, charge-offs, risk premium, and operating expenses are the important components. And as a result, credit card ROA is more than 4 times higher than the banking sector average due to the default risk premium and alpha. So this concludes my presentation, and I look forward to Larissa's discussion and also questions and comments. Thank you.
Larissa, please.
Okay, so first of all, thanks a lot to the organizers for inviting me to present this to discuss this very interesting paper that I enjoyed reading a lot because, I mean, it gave me a great overview of a market that has not been studied yet. You have also a lot of observations, like the first paper today, 800 million, 300 million, so great data set. And I'm going to focus a bit more here, generally summarizing the paper and then giving you some suggestions, since the paper is already very long and very detailed and you've done a great job already. How you could explore more some of those channels. So what is the paper doing? You're asking 2 questions. On the one hand,
why these credit card interest rates are so high. So you present different channels, right? So is it the operating expenses? Is it the charge-off rate, interchange rate, or is it basically default risk? And then the second part of the paper is trying to understand sort of what are the factors explaining this, where you present also this default risk premium model. You have a great data set, as I already mentioned, of 330 million individuals, of 20 largest banks that even to other statistic accounts, even to 95% of the total market, which is quite great. What are the main findings here? So you find first that the default rates explain only 5% of this sort of around 23 or 18% spread in credit card rates. So it's only a small portion, which is very surprising. Then we have the non-interest income that offsets the expenses, so there's not much here in terms of contribution to the high interest rates. You have the large operating expenses, where we'll go on more in detail here, and then you have the still 6.8% ROA, that is even 4 times the banking sector ROA, and when you build this default risk premium model, you still end up with amazing alpha of 1.17 and 1.44%, which is great, so it seems to be a very profitable business. So overall, my first general assessment of the paper, I think it's a great paper. It gives us insight of a completely new sort of market, right? First empirical evidence on determinants of these different interest rates with this granular data, and then the economics of the credit card banking, which you even call just a bit in the paper, the credit banking franchise, where you could maybe even expand it even more. I think in your paper, in the presentation now, you also didn't do it, but I think you could even call it credit card banking franchise, because I mean, it's amazing what the premium they're making. So you have this unique data set, and what am I going to mention, to focus on was more on this market power channel, because so far you're looking more sort of at the expenses, but less on the interaction with the borrowers. Then you sent me already the previous, the updated version of the paper, where you actually already explore sort of more the dynamics of the profitability, which I actually had also as a discussing point, and general implications of this paper. Given that you have this amazing data set, you also have not just the FICO score, but also income and geography, which I think you could explore even more to make broader statements about how it affects consumers overall. Okay, so here this is a graph actually not from a paper, but from the Federal Reserve and the Consumer Protection Agency. So I read an article on this market here. So as you mentioned, charge-off rate, non-interest income do not explain much. And this is also amazing to see in this other plot based on other types of data here, right? You see the APR margin is increasing since 95, despite the low interest rates. I mean, I find it's incredible, especially in this time period. And the charge-off rate is going down, and the spread is widening, which also is very surprising, right? And then among the costs you studied, the main one you're suggesting is this marketing expenses, which is as large as large firms here. And the interesting chart that I also found from the Consumer Financial Protection Bureau, they show the market share of the top 10 issuers, which is in green, and then the next 20 issuers, which also stayed relatively constant between 2016 and 22, right? So the spread is widening here, market power stays relatively constant. This is not related to the marketing expenses. So I was wondering whether you could do a bit more, trying to show what is going on with this market power and also sort of the franchise that they have relative to the customers. And here I'm relying more on the banking literature for firms, where often it has been shown that banks sort of misuse or use sort of the credit registries to see more or less about borrowers. And here I found similar evidence from the credit bureau, where basically they say that banks are not sort of only spending a lot of marketing efforts here to retain or attract new customers, but also they're trying sort of really to grab these customers and not make it possible for them to switch banks, because they're basically engage in this new practice of withholding monthly payment status. So it's basically the opposite of what Manju was presenting, is closed banking. So they're really trying to hide data to make it even harder for customers to switch. And I think this is also very interesting angle, given the fact that you find that the most spread that they're making is exactly in this low FICO score, probably also low financial literacy segment, and this is probably where they're able to exploit it the most. So you can do more on that, showing sort of more results on this data set, who are the banks that are engaging in that. And then also to see more sort of over time within the customers, what's the churn rate? Is it the existing or the new customers they're trading? What is driving this sort of marketing power? So far it's just operating costs, but you mentioned the switching costs and so forth, but I think you can do more here. Sort of what constitutes the strong pricing power that they have. You could also exploit here the age and the income. And the last part, which surprisingly I didn't find anything on, there is no effect of new entrants affecting the margin on entering. So they should be entering as of 2020. Maybe the US market is different. Other forms of credit card banking, that would be also interesting to see, I think. Then the last, my second comment was, which you already addressed. I was also interested to see, since mostly you focus on the distribution across FICO scores, to see over time how is it affected? How did the great financial crisis play a role? Which, I mean, you have a plot here in the back where you show it does fluctuate a lot. So in red, you see here the return on assets for the credit card banks, whereas for other commercial banks in blue is relatively stable, but you see sort of this blip around COVID, which would be also an interesting period to exploit, which you have in your data set. And here also I find that the data set is sort of focused on the largest banks, and it seems the period that you're using, 2015 to 17, is basically a period where, as I showed in the previous graph, also from this Federal Reserve Consumer Financial Protection Agency, where you have this widening of the gap. So you might be picking up a period where they were extremely successful and extremely good at reaping off their customers, focusing on the largest banks. So maybe you should try to show a bit more. Is it really maybe the top 10 that are basically effectively dominating 86% of the market, that they are the ones contributing to the most of the effect, right? So you see nicely here the margins, prime rate relative to PA margin did increase amazingly exactly in your period, which is like around 2015 and 23. And then lastly, broad implications, because I also want to be on time and I don't want to stand between you and lunch. Here I was thinking about more the broad implications, because surprisingly, even when you look at the default risk premium, and you try to sort of plot it, connect it to your distribution of ROAs, which you see here in black, somehow this blip between the prime and non-prime customers you're not able to capture. Also, when you look at the expenses, right, they're all relatively linear, and I was wondering how much you can exploit here around the prime and non-prime. You could do more. And then I was thinking even more, right, what are the general implications here of this higher credit card rates in terms of geography and income for welfare implications and sort of serving or exploiting the most underdeserved customers, which you could do probably. And here it would be interesting to see, are they able, and this graph suggests this, especially the undeserved one are the ones that are probably exploited the most, and maybe there's some cross-subsidization. There's a paper by Andres Silva, I think, that exploits that is going on here, where the banks are sort of trying to reap the benefit. So I have 70 seconds, right? So I'm trying to be on time. So I think it's a very interesting paper that really gives us a new perspective on the economics of credit card banking. I would like to see more on market power, but I think it's, in general, it's a very interesting read. And good luck with the paper. Thank you.
Thank you. Would you like to have a couple of minutes to reply, and then we open the floor for questions?
Yeah, sure. Thank you so much for your thoughtful comments. I like all of your comments. We will take them on board. Market power, ideally, we want to have a shock to market power, which we haven't found a good one, but there's going to be a large merger in the United States, so we might be able to do something there, but I like your suggestions. We will try those first. And the dynamics of profitability, why did the margin increase over time? That's exactly what we are working on right now. So we are pulling more recent data to understand which part of the revenues and costs are driving the higher interest margin. And the prime and non-prime, the very sharp discontinuity there, that's actually our next paper. We are going to explain that.
Yeah, I was thinking you can indeed exploit this,
exactly.
actually.
It's a good point that we also have zip code, so we have nice geography and other borrower characteristics we should be able to exploit. So we will take all of your comments on board. Thanks so much.
Thank you very much. So let's see a question over there.
Hi, very nice paper. I'm wondering how you're thinking about credit cards as an element of a banking relationship by which some of these extra normal profits that you see in the credit card market may actually be compensating for the losses, potential of a loss leader product. Which related to that, for example, think about debit cards that maybe banks may be losing money on them, but could be the entry point to later on offer credit cards, or think about apps, banking apps, that is like a common cost that serves the entire bank and needs to be covered with the profits of some arm of the banking activities. And related to that, on that alpha that you find for credit cards, as I understand, the FY14 reports interest charges at the account level. No? That is like how much a particular borrower is being charged on their monthly statement in terms of interest. But that's not always the same as interest revenue for the perspective of a company, because individuals that don't make the payments are charged interest, but that's money that never goes to the credit card issuer. So that's distinction between interest revenue for the lender and interest charges for the consumers. I wonder if it could be potentially explaining some of those extra normal profits.
Do you want to respond first? And then it was an articulated question, and then we move and open up for few more questions?
Oh, yeah,
you
sure. Just briefly, so I think what you're mentioning is captured by the operating, your first point is related to the operating expenses that we are, because we are capturing in terms of broad categories, we are capturing in operating expenses. I would love to hear more ideas about how to improve it. And I couldn't understand your question about interest charges and revenues. The numbers that we are showing is the effective interest charges. So how much the consumers paid is exactly how much banks received as interest income. So I wasn't exactly sure.
Sorry, the amount that you are charged when you don't pay, as I understand it, the FY14 reports the charge. So think of an individual that is defaulting on their credit card, every month is being charged a high amount, but that's money that doesn't come.
I don't think so. We are actually getting not just the charged, but the paid amount that banks are collecting.
Okay.
Yeah.
There was another question over there.
I love this paper. Thank you. Especially as someone who paid these exorbitant interest rates for some time. I really appreciated it. At the very beginning, you showed some other interest rates that look nothing like the credit card interest rates. But I would have liked to see the consumer loan interest rate among those. Right? None of those were, in any natural sense, substitutes for the credit card interest rate. Yeah, and I think there is a very nice analysis to be done whether other consumer loans behave similarly or not. I also would like to note that the argument about advertisement in operating expenses isn't very natural, right? I spend a fortune on advertising, hence you have to pay me a lot, isn't the kind of marginal cost argument we usually have in mind. And so it's really in the alpha. If the alpha weren't there, they wouldn't be competing this way. They wouldn't be, spending so much on advertisement, and therefore they wouldn't be seeing these operating costs either. So I think there is some very reasonable argument to be made to not include the advertisement bit of the operating costs in the overall operating costs, and to see that as something that is, forked out by the consumer for no useful reason. Thank you.
Yes, thank you for your comments. The consumer loans, obviously we want to match it, but unfortunately we are not able to merge. Like if you have consumer loan and the credit card, we are not able to identify the same person, so there's limit to what we can do there. But of course, at the aggregate level or the risk premium analysis, we can try. So thanks for the comment. And the operating expenses, we will think about it a little more. Thanks.
Any more questions? Over there. Yes.
Hi, thank you so much for the presentation. This is super cool stuff. I have a question as well about the market power and the marketing expenses. I'm wondering in what dimension this is particular to the credit cards, and in the sense that if the banks have market power in the credit card segment, they would also have it, for instance, on the mortgages. So wouldn't it be something that you also see on other products? And is the marketing expense that you have in mind tailored to the credit card segment?
Yeah, that's a great question. Yeah, I mean, in theory, yes, but we haven't done anything on that direction.
Any more questions? Oh, okay. Yes, there, Christina.
Hi. I wonder how much of the market power is coming from the fact that you have to, in the US, you have to have a credit card to have a credit history, establish a credit history, which is a really costly way of establishing a credit history. So I wonder how much market power this gives to these banks, as opposed to what we have seen in India, where in Manju's presentation, where there was a really cheap new method of establishing a credit history.
That's interesting idea. We haven't thought about it. I mean, on the top of my head, I'm not sure how we can show anything in terms of like quantifying how costly it is to build a credit score, and then how much of the market power is exactly driven by that we will have to think about it. But it totally makes sense that that's very relevant. We'll think about it.
Thank you. Any more questions? No? So maybe I can ask one?
Oh, sure.
Yes. So I was wondering whether you looked at the other side of the market. So there are the consumers on one side, the merchants on the other of the credit card, right?
Yeah.
And if this higher interest rate that they charge to the consumers mean anything or have implication for what they charge or offer on the other side to merchants?
Yeah, but merchants, we don't have we don't have data on we have nothing on that side.
Okay.
So that's quite unfortunate. Yeah.
Okay. Too bad.
Yeah.
But so I think we can close here this very interesting question. So I would like to ask you to join me in a round of applause for all our wonderful presenters.